Hi, everybody. My name is Ashley Errigo.
Hi, I'm Lakin Woodward.
Hi, everyone. My name is Dylan Cushner.
And hi, I'm Lucy Scarangella, and this is our review of the week presentation. So let's get into it. So just take note that the dark blue is DGIA, the purple is S&P 500, and that light blue is NASDAQ. Something you'll notice, though, is that NASDAQ sits much lower than the other two indexes. Now, this variance, there's a lot of speculation that could be causing this variance. However, what I see the most is that it's due to tech stock prices dropping. But now looking into, just start from the beginning of the week, we see Monday, it's pretty even. We see a small dip before noon. Then following noon, we see well, it's a bit of a wave going on, but overall, it's a pretty mellow increase, but an increase nonetheless. But we do end on a low note with in the red, which leads us into August 30th, where we see that strong dip. Now, many attributing factors to this dip, but one main one is the prices of oil stock just falling. We do manage to see, though, it bounced back pretty quickly, but it doesn't level itself out at all. It continues to maneuver all over the place, between decreasing, increasing again, but does manage to close out in the green, which they were not able to do on Monday. Leading into the 31st, we do see it's a little more stable, not necessarily level in its decrease rather than any staggering dips or high peaks. It's a pretty gradual decline. And we end up closing out in the red, the highest volume of the week of stock sold, however, in the red, which, looking at how this month ended, it's really unfortunate. A lot of reports are comparing it, saying that it's the worst month since June for the stock market, and it's just an unfortunate closeout to the month. Now, looking at September 1st, the beginning of the new month, we have the staggering lows. It's we have our lowest point for both S&P 500 and NASDAQ of the week. S&P 500 sitting at 3,903, and NASDAQ sitting at 11,546, I believe. Now, Dylan and Ashley will be getting into the different financial events that occurred over this week, but somehow they managed to pull through. It could have stayed low, gone lower, but they managed to close out in the green for the day, and close out higher than where they started. And while it isn't like where it was at the highest point the day previous, it's higher than it was the entire day of the first, which leads us into the increase, the beautiful peak of September 2nd. While it's not as high as where we started out on the 29th or the highest peak of the 29th, it's much higher than it was on the 31st, and higher than the majority of where the prices sat on the 30th. This was attributed to labor growth reports, which I know Dylan and Ash will definitely be getting into next. However, that rise does not last. After 12 p.m., we see it start to fall again. It's pretty steep. I wouldn't say as steep as it was on the 30th, but near second. And then this day we actually see the lowest low for DGIA at 31,186, I think, which is just really unfortunate that we closed August out on a low note and we started this month out on a worse one. We can only have hope for things to turn up. But a lot of the uncertainty surrounding the market right now is with the government's response on how to handle the inflation rate, and what it'll mean for the stock market. I'm gonna let Ashley and Dylan get into that, but that leads us into our first question. Based off of this week's performance, do you think that the stock prices will continue to fall? And if you do you think it's going to be something that's a little more steady and gradual as it was for the 30th, or 31st, I mean, sorry. Or do you think it's going to be strong lows, high peaks, unstable, as we saw with the 1st and the 2nd of September? And then if you want to play the optimist card, if you think it's going to if it's going to make a turn for the better and stock prices will begin to increase, why? Okay, now I'm going to turn it over to Ashley and Dylan.
Hello again, everyone. I'm going to go ahead and get us started on some of the major financial news and events from last week. First, one of the biggest highlights of last week was the August jobs report. I'll get into the details of the report here shortly, but first I'd like to show you the equity markets from Friday when the report released. So the report came out Friday morning, and as you can see, investors responded to it quite well. As you see, a lot of buying signals here, a lot of bullish activity in the pre-market, and that momentum carried through market open at 9:30 and through the rest of the morning. Around lunchtime, you see the day sold off pretty quickly and steeply erased those morning gains, as reality kind of set back in that higher interest rates are coming as we head into September, and we just a very underwhelming and dull cap to this week in the market. So some of the details from the report: payrolls increased by 315,000. This is good. We were expecting just under 300,000 additions, so being able to reach that goal and break it by just a bit is definitely a good sign. One of the most important parts of this report was that the unemployment rate went up just a bit. Now, it doesn't sound great, but doesn't necessarily mean bad news. And that is because labor force participation increased by 0.3% last month. That is the largest monthly increase since early 2020, pre-pandemic. And there was about almost 800,000 new labor force workers. And that is why our unemployment rate went up, because unemployment is calculated using the amount of people in the labor force who are unemployed, not just any person that is unemployed. So the most important part here is finding these new participants' job openings. Some caution points related to the jobs report are listed here. The one that interested me the most was that the retail sector stood out and created 44,000 new jobs last month. It really interests me because we've seen a lot of negative retail data, and we can definitely assume that the retail market has continued to struggle going forward. So I'm really curious to see if this hits a ceiling over the next month or so, and we see a pretty good decline going forward. The second event I want to go ahead and cover is the U.S. housing market update released by Realtor.com. Overall, pretty good news from this report. The housing market is definitely moving in the right direction. We're finding a little bit more balance between buyers and sellers, and it's becoming a little more buyer friendly. There were fears and worries of a housing market crash, so hopefully these are some good indicators that can increase hope that we can avoid that. over the next few months and in the future. And on the graphic on the right, it's a little difficult to see, but for summer 2022 and fall 2022, that's where we have these updates from Realtor.com. Summer 2022, we had 15% increase in year-over-year growth in actively listed homes, and that's great news. The more houses on the market, the better for buyers and purchasing options. And then for fall 2022, where we have our update, we're expecting 3.8% increase in wage growth. And this goes hand in hand with the job report, because as we're experiencing recovering and growing job market, this will give families and individuals more comfort making large purchases such as a home. So my question, the jobs report and housing market update were fairly positive amid overall downward trends in the economy heading into September. Do you guys think these August results could signal a possible soft landing, or do you believe recession is ultimately inevitable and there's not much we can do at this point?
All right, hi again. So today I will be covering two major financial events that happened last week and taking a look at kind of how they affected the stock market in last week's performance summary. So the first of which I'm sure all of you have seen in the headlines, is the unfortunate event of the CFO of Bed Bath & Beyond, Gustavo Arnold, falling from the New York Tribeca skyscraper last Friday, September 2nd. And it kind of makes you, take a look at the company and kind of see what's going on, why is this happening? So specifically speaking, in terms of the company itself financially, as well as Arnold himself. So the company's not doing so well financially speaking. Last week, they announced a large decrease for the second quarter. Specifically speaking, there was a 26% decrease in sales for the second quarter. They are losing a ton of money, a lot of revenue. So they are planning on cutting a lot of jobs and closing 150 locations. So obviously, the company itself is not doing so well in terms of growth, in terms of sustainability. They are simply just declining in revenue. So speaking of Arnold specifically, the CFO, on August 23rd, he was actually sued for a pump and dump scheme regarding the Bed Bath & Beyond stock, and also was involved in issuing materially misleading financials. So obviously he kind of knew what was going on, that the company was not doing so well and is kind of getting caught up in the downfall, so to speak. So taking a look at the stock last week, this is a picture of the full last week's performance for Bed Bath & Beyond. You can kind of see that it's starting pretty positive in the beginning of the week, and it actually is, Bed Bath & Beyond was considered a meme stock. So you can kind of see on the 31st when that announcement was made of how they're truly doing. Hard decrease, big drop in the stock performance. And then it's kind of trickling down, maybe staying a little bit steady until, unfortunately, the CFO passing away and kind of confirming the financials, and the company's just kind of going towards the end. Maybe not closing, so to speak, but just not doing so well financially speaking, and obviously not a very positive outlook to the future. On a more positive note, the second financial event that I will be covering that happened last week is regarding Lululemon announcing their second quarter financials, and obviously looking at the third quarter, the annual year, and their growth as a company moving forward. I'm sure everyone's heard of Lululemon. They are everywhere. They are growing very quickly. And the CEO and CFO were very clear about their growth and their positivity towards the future last Thursday, September 1st, specifically talking about they're gaining their momentum back in the second quarter from the first quarter, and they have a very strong outlook moving forward in the year. So let's take a look specifically in the second quarter, looking at 2022 versus 2021. There was obviously an increase in net revenue, an increase in gross profit. Specifically speaking, their net revenue increased 29% up to $1.9 billion. Their gross profit increased 25% for a $1.1 billion. And then they actually opened 21 new stores. So very solid second quarter of 2022, very strong growth. Very expansive growth in terms of physical locations as well as financially. And then they kind of shifted gears and kind of looked ahead. So looking forward, They expect the third quarter to be stronger than the second, obviously. So they're expecting a net revenue range of $1.78 to $1.805 billion in the third quarter, which is a 3-year compound growth rate of about 25%. Speaking about the gross profit, that obviously is going to go up as well. And then annually, they are expecting $7.865 to $7.94 billion for the total year of 2022, which looking at a 3-year compound growth rate, it's 26%. So pretty solid. And then they did kind of mention their power of 3. So I kind of have an image over here. So through their innovative products, their guest experiences, and expanding their markets, they are fully intending on doubling their 2021 net revenue of $6.25 billion to $12.5 billion by 2026. So strong second quarter, very positive hopes for the third quarter, and then obviously a strong outlook moving forward, not only this year for 2022 wrapping up, but the next couple of years as well. So very strong growth for the company and very high expectations from their CEO and CFO. So it's kind of taking a look at how it affected their stock. You can kind of see it's pretty maintaining, and then they kind of announced that they are going to be talking about their financials. Obviously, people get a little hesitant, a little worried, kind of freak out a little bit, unsure of how that announcement's going to go. So it drops a little bit on the first, as you can see here. And it kind of like gradually picks up a little bit. And then obviously they make their announcement of how well they're doing and how great they're expecting to do in the coming quarters, years, and just how fast they are growing both financially and expanding wise in the company. You can see that stock is shooting way up on the second, and then it's finishing stronger than it started in the week at the week close on Friday. So that brings me to my question. So last week, Professor Leggio kind of touched base on how the retail market is struggling a little bit. So considering those struggles within the retail market, why do you think Lululemon is experiencing and continuing to expect immense growth moving forward? Clearly based on their announcement about Q2, Q3, annually speaking, and then up until 2026 with their plan moving forward. Why do you think that this company specifically is experiencing such growth, and is this growth sustainable? So just something to think about.
Okay, so now we're going to move ahead into the looking ahead portion of our presentation. And a few of the points that I want to touch upon will be how September is usually the weakest month for stocks, as August did end down around 4.2%. And there are 2 important dates, September 13th as well as September 30th. We will also touch upon Jackson Hole, Wyoming, Vanguard in China, and the US estimated recession. So as for September, there is something that is called the September effect. So this is usually when investors are now coming back from all their vacations, from their trips, and now they are starting to sell off the things that they were invested in, maybe to pay for the trips, or maybe to pay for things like schooling for their family, tuition and books and such. So that's usually why September is a little, is like not the best for stocks. But as for the Jackson Hole, Wyoming meeting, this is a meeting where there's central bankers, policymakers, other influential thinkers, academia, and they all come together to just have a huge conversation. And so this year's topic was reassessing the constraints on the economy and policy. So it was pretty rocky all around, but it was pretty promising with the Fed trying to bring supply and demand back into balance. So as for the labor market, it is pretty steady, not at the levels that we would love it to be at, but with the pandemic, behind us and still kind of lingering, it's not doing too bad. So if the job labor market still remains steady, then the Feds will most likely be able to pull back on the rate hikes. So as for the 2 important dates, September 13th and 30th, September 13th is when the August Consumer Price Index will come out, and this will show if the July data was a fluke or if peak inflation has really arrived. as for September 30th, this is a little bit more important, I would say. This is when the true measure of inflation will be shown. So a lot of investors will kind of hold off doing anything in September until they reach September 30th and get all this information. So now we'll be talking about Vanguard and China. So Vanguard is downgrading their China growth forecast from the usual 3 to 4% to 2.5, 3.5%. And this is really due to the housing market. So their housing prices are declining, and that is just not good for them because this is usually like a very important balance sheet item to them. So that's probably the main reason why the growth forecast is really going down. There's also weak consumer demand. So consumer spending is going down, and like investment and credit easing is just losing effectiveness in the market. So they are just really struggling. So lastly, as we talked about in module 1, if we'll have a recession, if we won't, if it'll be now, if it'll be in a year or so. So according to my sources, the US recession is estimated within 12 months at 25% and 65% in 24 months. So this can be attributed to, as we learned, like the inverted yield curve, as shown in the picture here. So like we talked about, who knows if we will have one, but in reality, the National Bureau of Economic Research is the group that really decides if we'll have a recession, and they've really based it off the labor market and the industrial production, and both of these are pretty steady or strong. So who knows, they might not even call for a recession, but we can also kind of look towards Europe a little bit, since Europe and the United States are pretty intertwined and have a pretty good tie on each other. Europe is estimated to have a recession soon, and this could be a really big factor with within our markets and if we'll have a recession or not. So as for our question, do you think we will have a recession within 12 to 24 months, or do you think we will stay afloat? If we fall into a recession, what are the benefits?
And here are our sources, and just a compilation of our questions for everyone. And thank you, and I hope you enjoy our presentation. Can't wait to see everyone's responses on Friday.